People live in homes, not corporations. This is what Donald Trump recently said in regards to his administration's new proposal to ban big investors from buying homes. And for a lot of people, myself included for a long time, it just makes sense. If investment companies can't own homes, that will add more supply for individuals and therefore lower the cost. However, that might not be as true as I thought and many people think. And there are individuals and families that could be worse off if companies cannot own single-family homes too, as they usually do, rent them out. One reason being that institutional investors the administration will target hold less than 1% of the housing market share, and much of that share is located in just 22 counties around the country. Two being that home investors often go for the reduced price housing in need of major renovations, since they have the capital to buy multiple homes in need of work and then acquire multi-home contracts to fix them at a lower rate, which is actually very good for the market, especially after recessions where large-scale foreclosures happen. And lastly, offering a low percentage of single-family homes as rentals can be good for families that either don't want the responsibility of owning or are not going to be in the area for a long period of time. That being said, the original notion of preventing investors from buying homes opens up supply to individuals does have a grain of truth to it. But if the idea is that that will lead to widespread lowering of housing costs, people might be pretty disappointed. The real way to lower housing prices is to increase supply, and it's the local zoning laws and housing restrictions that keep the supply behind the demand curve. First, let's expand on the first point and look at who these investment institutions are and where they tend to buy. A property investor is anyone who buys property for financial gain, and the vast majority of homes bought by investors are small-time mom-and-pop landlords with less than 10 properties. Of the 13% or so of homes owned by investors, 11% fall into that category of having less than 10 properties. And not all of those investors are companies. Some are just people who own multiple properties and may or may not rent them out. Less than 1% of homes are owned by large investment companies that are being targeted by the administration and the narrative more broadly. And those properties are relatively concentrated in a few areas. According to the Government Accountability Office, these large institutions control 25% of the single-family home rental market in Atlanta, 15% in Tampa, and 14% in Phoenix. And it's a fairly new phenomenon. Large institutional investors went from buying effectively zero single-family homes before the 2008 recession to being responsible for a decent percentage of home purchases in recent years. As investors' activity has grown, so too have complaints from politicians of both parties that they are outbidding would-be owner-occupant families, who are then being condemned to a life of perpetual renting. In Congress, Representative Adam Smith and Senator Jeff Merkley have introduced legislation to impose tax penalties for institutional investors buying single-family homes, or even force them to sell single-family units they've purchased. And several states have followed suit. Selma Hepp, chief economist at the property data company Cotality, points out that, like most things, there are trade-offs. Wall Street's preference for buying homes in fast-growing areas with healthy job markets makes it extra difficult to parse out how they influence rents. What happens first is you have a high-demand area where rents go up, and that's when institutional investors come in, or investors in general come in, not the other way around. Joshua Coven, an assistant professor of real estate at Baruch College's Zicklin School of Business, has worked to quantify the impact of institutional investors in the market. In a paper last year, he found that large landlords decrease rents by contributing to the rental supply, and policies like banning them or forcing them to cap rent increases could hurt supply and push up rents. However, he also found that by buying homes, large landlords decrease the supply of homes available for ownership, accounting for about 20% of the price increases in markets where they're most active. This makes it harder for people to buy homes because it does raise prices, he said, and it lowers the amount of homes available for an owner-occupant. At the same time, they're then renting these homes out, which increases the rental supply. So if we're solely concerned with home buying costs, the steps the administration is taking may have some purchasing effects in specific areas and marginal effects everywhere else, but it will also have negative rental effects in the same way. But investors may be at a natural limit anyways. Eric Seymour, a Rutgers associate professor who studies private equity in the housing market, says that the largest corporate owners are at saturation. Some of the largest actors, like Invitation Homes and Blackstone, not to be confused with BlackRock, grew to scale in the aftermath of the foreclosure crisis when they're able to buy large numbers of homes at low costs. And that window is closed. In recent years, Seymour says, these companies still buy homes, but mostly through acquisitions of smaller corporate landlords, or by investing in build-to-rent housing projects that don't affect current home ownership. And it's perfectly possible for the legislation to not even work. If Trump succeeds in passing a ban on larger investors, who's to say that they wouldn't break themselves up into smaller shell companies to avoid the ban? And banning investors in other places has already failed. Rotterdam in the Netherlands banned them in 2021, which promptly triggered a 4% increase in rents, displaced lower income families, and led to homes being purchased more often by richer and older buyers. Not younger middle class people, proponents of the policy seek to help. If investors are driving up prices, the natural market response would be to take advantage of higher prices and build more, so that home builders could sell to both investors and families, again increasing supply and bringing the market back to equilibrium. If supply can keep up with demand, prices shouldn't fluctuate much outside of normal inflation, regardless of who is buying the homes. But prices have increased, meaning that supply hasn't kept up. According to a recent paper in the National Bureau of Economic Research, government regulatory barriers, including zoning restrictions, minimum lot sizes, limits on multifamily housing, and long and costly permitting processes have made it difficult, if not impossible, to meet the rise in demand in a cost-effective way. The paper finds that if the U.S. housing stock had expanded at the same rate from 2000 to 2020 as it did from 1980 to 2000, there would be 15 million more housing units. This means that the surge in home prices should have sparked a supply boom, but the annual pace of 1 million new single-family units in December of 2024 is about the same as it was at the end of 2019. Rising construction costs and a lack of available labor have hampered new construction, and other factors, including a surge in immigration, have made supply and demand imbalances worse, pushing home values higher. Institutional investors have not always gotten such a bad rap, which leads into the second point, that many of the homes institutional investors buy need repairs. And because of operational and financing advantages, these institutional investors can repair these properties more quickly and efficiently than an owner-occupant generally can. Institutional buyers have two significant advantages over owner-occupants in purchasing homes that need significant renovations. First, they can use economies of scale when doing major renovation work and chain multiple homes together. Second, they have a financing advantage because they can pay cash sourced from capital markets, whereas owner-occupants often need a rehabilitation mortgage that is typically more expensive and difficult to acquire than a standard mortgage. Annual reports from two of the largest single-family institutional buyers illustrate the substantial amount institutional investors spend on these renovations, even with some of the volume discounts. The Invitation Homes 10K indicates that it spent $39,000 per home for upfront renovations completed in 2020, and American Homes for Rent's 10K in 2020 notes that they typically spend between $15,000 and $30,000 to renovate a home acquired through their traditional acquisition channels. Their extensive experience, internal capacity, reliable vendor relationships, and discounts yield more time and cost-effective renovations than a homeowner could generally achieve for the same work. Now again, your opinion of large housing investors can be different based on what variable or variables you care about. Coney Chang, an economics PhD on the Federal Reserve Board of Governors, found that the buy to rent strategy was hurting the middle class. Creating rentals aided lower income families and nudged rents down, but reducing the supply of homes available for sale also pushed home prices up, hurting families on the cusp of home ownership. And the problem that many people are facing is that, sure, institutional investors can decrease rent in an area by increasing the rental supply, and that's cool for some, but most people don't want to rent their entire lives, especially when they get older and retire. People envision living in a paid-off home, since it's hard to pay rent when you're no longer making a steady income, and property taxes on a home you own are nowhere near the same as monthly rent. The key is to even the playing field between investors and new buyers. There are various government incentives for large property investors, so if you're going to offer incentives for investors to buy homes, especially in the wake of a recession, it would make sense to offer comparable incentives to people. One that Ingrid Ellen and Lori Goodman point out in their piece for the Hamilton Project is improving renovation financing for owner-occupants. Otherwise, you make investment buyers much more appealing to sellers than individuals, since they can buy without financing and often take more risk by waiving some of the procedural aspects, and end up with an unfair and unbalanced market. And states have created other programs to help first-time home buyers. You also have to make sure that intermediate costs of home building are low, which COVID inflation, supply chain issues, and tariffs have made building modestly priced homes almost impossible. Harvard's Joint Center for Housing Studies 2022 report highlights the increases in these costs, and that's even before tariffs were considered by U.S. policymakers. Their 2024 report reiterates these continuing problems and discusses how swelling immigration has influenced housing demand, another basic component of rising prices. Because of the very concentrated locations of private equity home buying, it doesn't really make sense to do a nationwide ban, if a ban at all. What might make more sense would be for certain cities or states to gradually limit the number of single-family homes that can be rented in their jurisdiction until a good equilibrium is found, especially short-term rentals like those used for Airbnb. You want to incentivize building new housing and buying rundown homes for renovation, but you don't want large firms to have an unfair advantage when competing with individuals or families. And forcing these companies to immediately divest doesn't guarantee success, because you could end up with a lot of empty houses and investment losses. The complex give-and-take nature of market decisions have often caused government interventions of the past to have numerous unforeseen consequences. So putting a federal thumb on the scale can create problems for a situation where it's unclear whether there's even a problem to begin with. With the drastic rise in home costs, there's plenty of incentive for home builders to take advantage of the prices. So it really comes down to state and especially local governments getting out of the way and letting developers develop, upping supply and providing people with more options and price points. Sure, that doesn't mean selling off national parks or allowing unsafe conditions, but there are plenty of insane, arbitrary requirements hindering the industry from providing what people want. Those are the policies that need to go, and simply banning many of the people with the most incentive to invest in the industry probably won't help. Thank you for watching. Let me know what steps you think we should take to make home buying more affordable. If you enjoyed, don't forget to like and subscribe, and I'll see you in the next one.